Good afternoon, everybody, and welcome to another edition of ChartWatch Live. My name is Capolingua, and it is a pleasure to be with you today as I join you from Market Index and Livewire. Of course, I should mention that. We're going to get into a bunch of your great stock picks today. We'll obviously talk about the portfolio management model, and there's a whole lot going on markets, and no doubt there's going to be plenty of your requests. So let's get stuck in. Here we're going to talk about our portfolio management model, which if you're trading US shares, and I know you might not be, but we like to look at this because no doubt what happens here in America has an impact on our market. And if you follow my analysis in the ChartWatch markets articles I put onto the Market Index site, you'll know that we are FRP, full risk position. Now, that's my own personal portfolio management model, where if I think the market is in a strong trend, then I can allocate up to, 100% of my capital. I can be fully invested. Now, that just doesn't pick individual trades. It doesn't tell me to go out and buy Amazon or Google or Microsoft, but it does tell me that if I was invested in those things, I could use up all of my capital. Sounds extreme? Well, not really. Your typical managed fund, balanced fund can be up to about 90% invested in various assets, and they might have up to 10% cash, but generally only 5%. So it's actually not that extreme. It just means make hay while the sun is shining. And how do I know when the sun is shining? I look at my trend ribbons, the all-important short-term trend ribbon. I like that to be obviously rising, very important. It tells me that short-term traders are looking to buy the dip. If that trend ribbon is supporting the price, acts like a bit of a trampoline is probably one way to say it. So when the price comes back to the short-term trend ribbon, it bounces up and it bounces up and it bounces up and it bounces up until it does it. And that's when we take note. Before it does it, it might turn amber, neutral, telling us that something's not quite right with that short-term uptrend. We're losing a bit of momentum. We're seeing supply side control starting to creep into the market. Supply starting to build to the point where maybe it's equating the excess demand that was in the system. Was there excess demand in the system? Of course there was. Look at all those wonderful rising candles and peaks and troughs. Of course there was excess demand. But when we go amber, that's a little bit of a warning sign to just pay a little bit more attention. Obviously, if it turns pink, well, we've definitely done something by then. Long-term uptrend ribbon, that's the dark green zone, and that keeps rising. This is more like what the longer-term investors, the really big positional funds are doing, and obviously they still like it as well. Then I drill down. That's a very quick overarching summary, my trend ribbons. Then I drill down to the price action next, so rising peaks and rising troughs, and we're going a little bit more shorter term now. And I like to see, obviously, rising peaks, rising troughs tells me demand side control. If we see a mixture, again, maybe the supply side's coming in to equate some of that demand, and if we go to falling peaks and falling troughs, then supply side has control, and then we take some action on that risk management model. I do anyway. You can do whatever you want. I'm going to keep saying that today, but I bring that back, and it might come down to 2/3, it might come down to half, it might come down to 1/3, depending on just how bad the market is. And to put it into perspective, it wasn't that day there, but that day there back in December last year. Geez, it feels like not that long ago. I would have said something to you along the lines of, look, we need to start monitoring markets, be careful, it's not the easy trend we had, or maybe that day there or that day there. Even I might have said, oh, look, just for precautionary measure, going to go back to 2/3, certainly if not that day. And this is all in writing, it's all in black and white on the website. You can go back and check. And no doubt about it, by that day there, absolutely having brought down risk levels probably to 50-50, no more on that day. And I'd say by there or even there, probably down to 1/3 risk, which is my most risk-averse setting. I don't go below that because there's always still opportunities in markets, even in bear markets. And I want to say on the way back up, I think we went probably back to 50-50 on that day, probably back to 2/3 on that day, and full risk position, no doubt, by there. So that's just how it works. Again, it's all in black and white. You can go back and check the tapes, as it were. But just to give you some insights into how it will play out this time, because I'm consistent. It's a model. The rules are set in stone. I teach them to you every day. I write something on Market Index, or we do one of these webinars, and it'll play out the same way. But in the meantime, there's nothing to do. FRP. Now, I don't know what's going to happen next, just like I didn't know last time, but I can guarantee if something untoward happens, we'll see it here, and we'll know to pare back our risk. Now, with that little bit of an introduction, we can do the ASX 200 really quickly. This one's probably more relevant for many of you listening today because it dictates my risk on the ASX. So how much of my portfolio that I've invested towards the ASX I can allocate, and we were still FRP there. And you might say, hey, Carl, that last candle doesn't look good. And you're right. Doesn't look good. We've got a black candle. We've got some supply coming in, a pesky supply, frustrating supply, particularly after we looked so good yesterday and really for the last week or so. There's some stuff going on that we'll talk about in a minute as to why that might be happening. But do you jump at one candle? Do you go, oh, there's a black candle and that must be the end of the bull market? No, that'd be the silliest thing you could do. We look for confirmation. We look for changes in price action. We look for interaction with the trend ribbons, and none of that's happening yet. So here's a bit of a problem with my model, ladies and gentlemen. I'll be honest with you. I can't pick the top. I'll never pick the top. I won't know it's the top because I need to see how that demand supply progresses. And that's a good thing because you don't want to be getting out too early. You want to ride that trend for as long as you possibly can. So let me just go ditto on what we said last week. That's a long way to get there, but FRP on both. And of course, we're going to continue to monitor to those situations. And we were all the way down at Zinc a little while ago, weren't we? So let's head back down there now because I wanted to, the reason why I was down there is obviously markets, we've got the big black candle. So I was trying to figure out for you lot, well, what could be causing that today? I was trying to go through all the overnight markets and figure out what's the key driver behind it. And no doubt you will know what's going on with gold and silver, and we'll discuss those in a second. But part of it was looking through the base metals here. So we're looking at London Metals Exchange data here. So aluminium looking very well. If you're wondering why your resources stocks are doing so well, part of it is explained by these charts. Aluminium doing well, copper doing very, very well, and up last night. Iron ore doing okay, and pretty firm based on the last 24 hours. Yeah, nickel ticked up, lead ticked up, tin ticked up, and zinc, which is why it's on that chart, had a huge pop last night. And there's the bottom line is there are no answers there as to why we've got that big black candle on the ASX 200 today. But then we can go to a chart, for example, gold and silver charts, and obviously, you would have had to have your head in the sand for the last 24 hours if you didn't know what was happening there. We're starting with silver, and it was that big black candle where I tapped in ChartWatch markets. Today's Wednesday, maybe it was Monday. I'm pretty sure it was Monday. I wrote and said, hey guys and girls, this is not a great candle for silver. Something's going on here. Supply has arrived, and we need to be on high alert. And lo and behold, it didn't take long. 2 candles later, we get the big sell-off. Just bringing this back to the most important thing for us is, okay, it's a bull market, but when's the bull market going to end? Well, I can't answer that question, but I promise you, I'll see it for you in these candles, and I'll let you know if it is. What's the deal with silver here? Well, big black candles are never a good sign, but they don't always predict the end of a trend, but they are commonly seen at the tops, at major tops, particularly if they correspond with volume spikes and volatility spikes. So if they're big, you've got big candles before, the black candle itself is large, volatility is a great indicator of a lack of consensus. So low volatility, you can see the move prior to that was actually smaller candles, white candles. They're the good ones. Small white candles, even if a few black candles aren't bad, but fairly orderly, volume not doing anything particular because it's just the market in that mode of we're buying. We're excess demand, we're hoovering up what's out there, and nothing's really concerning us at this point in time. I did note that shadow, didn't I? That upper shadow, I said, hey, a bit of volatility creeping in, and then more volatility. I know that's good volatility, but it's just this idea that I actually don't have the other one here, but we can probably go to... there we go. So this is my optimized true range. A few people have emailed in and asked about that. That is, there's average true range. You've probably heard about that. And you can use average true range if you'd like, but I've optimized it, obviously. So this is my own personal version of average true range. I think it's better. And then I just plot a very long-term moving average so I can see what's above average and below average volume. And that's really all I'm going for there. I don't overcomplicate my technical analysis. I don't know if you've noticed, I don't use fancy indicators, and even with candles. Have I ever told you about that incredible candlestick pattern you need to know? I don't. I just talk about black candles and white candles. So simple is in my experience, always the best. And this is a very simple indicator that just says, are we seeing above average volatility? average volatility, below average volatility. And we can see that with silver, we had this volatility spike here. It corresponded with a volume spike, and it corresponded with the black candles. So that spike in volatility, it has to mean that market participants are in less agreement. It can only be that way. Prior to that, the candles were very orderly, volatility was down, volume was fairly orderly. It means we've got consensus, and as trend followers, this is our holy grail, this idea of consensus where people are agreeing and creating orderly low volatility trends. That's the best time to trade. When we have high volatility trends, it's harder to be a trend follower because the trends are more likely to change direction, and volume coming in often tells us that final influx of demand has come in. Those Johnny and Jenny come lately, so finally entered. And if there's high volume and those reversal signals, it's the supply side that got in very, very early that are giving it to them and precipitating some of those candles. Doesn't mean it's the end of the bull market here for silver. It just means supply's taken some profits off the table. They'll wait for a pullback. They'll see how it responds. They'll see if they'll move to the demand side potentially. They'll see what other demand side's there, and the trend may well continue. And now we're waiting for white candles, lower shadows, moving back into at least higher troughs, potentially getting close to that peak again to see that trend perpetuate. We want to see the trend ribbons hold. Obviously, we're closing beneath them. We've got issues. So it's still very early on silver, but you were warned. You were warned that this could happen, much like you were warned that this could happen on gold as well, because I pointed it out on that candle there and said, look, everybody, just a heads up, we've found a bit of supply. And if we found a bit of supply, then we're more susceptible potentially to a pullback if that supply is able to take control. If demand slips, is less motivated than it was prior to this point. So if you're wondering why the Aussie market's down, it's not so much, and I know a lot of the bigger resources stocks are down again. I think that's more likely to be, quote unquote, just a pullback on the basis that those base metals are still looking very, very strong, and maybe just a little bit of negative sentiment flowing through from what's happening in precious metals, but also probably a bit of hot money, maybe just taking a breather on the basis that they're getting a little bit torched in precious metals, and to pay for some of those losses there, they might be selling some of those other similar resources stocks. Look, that's my assessment for what it's worth, and we'll see how we go from here. The rest of the Aussie market looks like it's a pretty mundane old day indeed. I could continue to go up that list and look at all of the other commodities in the world for you, but I'm not, because we've got a busy schedule today of all of your online and offline requests. So I want to head over here, and hopefully that was a worthwhile little sojourn for you from our typical sort of agenda for today. So we will get to some more Aussie stock related items here. And I understand not everybody can attend each week, so we'll do a limited number of offline requests. I'm not going to do them all because I want to give people who are in session, a great opportunity to get their questions answered as well. But look, Harry's got HAS, and I thought this was an interesting question because he asked specifically, look, how do you deal with managing your risk on these parabolic growth stocks? What does parabolic mean? Well, that's a really good example of something going up in the shape of a parabola, so starting quite slow and then just really exploding in price, accelerating. And we've seen so many of these recently because so much hot money has come in, and it really does snowball. To some extent, it becomes that greater fool theory, isn't it? It's this idea of buying and hoping to sell to somebody else who's happy to buy at a higher price. But we look to the volume, we look to the price action, and we look to the volatility, we look to the volume to give us clues on when we might need to manage our risk. Now, this equals R, if you're not familiar with it, last week I might use a slightly different sort of labelling system, but I've decided during the week to keep it simple here. We've talked about this idea of, well, I've got three options to me at any time on any stock or commodity or index or crypto or whatever it might be, and that is I could either maintain my risk or reduce risk to it, or if I don't have it or if I do have it, in both cases I could add risk to it. So maintain risk, add risk, reduce risk, and I thought we'd just go with, if we're going to maintain risk, we'll just put an equals R on the screen just to keep it nice and simple. If I'm going to add risk, I'll do the plus R. Of course, you can do whatever you want, but this is just my view on whatever we're looking at, and I think that's the best way to go. So let's have a look at Hastings Technology Metals, one of those critical minerals companies that have got a lot of attention recently. And we'll go back to the candle that is highlighted in blue because that's the candle we had to look at last week. We actually looked at this one last week, and I wrote on the screen equals R. So if I had it, I'd be happy to maintain risk. Based upon the candle we had at the time, which was actually a black one because we're looking at these candles within the trading session, so they're prone to changing. So if you check last week's video, it was black. The demand came back in, and it actually turned out to be pretty, like a half decent one there that we see now. And I said maintain risk because I can't see the future. All I know is what I know up to that point, and up to that point. Let's try that again because it's a little bit difficult to click these sometimes. That's what I had to look at. And yes, we've got increased volatility. Yes, we've got increased volume. You can see here the red bars are always volatility. The blue bars are always volume. And don't worry about those other bars for now. So yes, we've got increased volatility. We should always be on alert. When things are volatile, we could easily get a big black candle. We can't take it for granted. When things are less volatile, things would probably just keep going on the way they were. Obviously, some volume there coming in with a candle. That's not that terrible at all. So every day of the week, that's a maintained risk for me. Next candle, what would we do? And each time you see a candle, I want you to think about, okay, what would I do based upon what Carl's taught me so far? How bad is that candle? We've got a downward pointing shadow. We can see that we opened up here because that's how candles work. If it's black, we must have closed below our open. So we opened here, we closed here. All right, but at some stage during the trading session, we were all the way down here. At some stage during the trading session, this was a substantial black candle. Much like on the candle before, at one stage, it was black as well. But the only way you can get these downward pointing shadows, and this is why I'm so obsessed with them, I don't tell you about, hanging man doji. Well, I guess it is a bit of a hanging man, isn't it? But I'm trying to think of some of the more extravagant, the harami patterns and, dojis and 3 black crows and 3 white soldiers. And there's some beautiful names in there in this encyclopedia of candlestick patterns. But I don't talk about any of those, do I? I talk about bodies and shadows. Bodies and shadows. Big, full bodies. Consensus. Shadows. Confusion, maybe. Indecision's probably a better word. Shadows. The price went up. People thought it was fantastic. But then it got sold down. It didn't stay there. The price went down. People thought it was time to sell, but the price didn't stay there. So shadows are indecision, and which way they're pointing is very important because downward pointing shadows tell us that the demand side, or we've had supply, but the demand side's come in, and upward shadows are telling us we've had demand, but the supply side's come in. So if we look at what's happening on this candle here, we've got this downward pointing shadow, which tells me, yes, it was looking pretty bad, but the demand side's come back in. So this is not the best candle in the world because it still has that black body. It still tells me that supply was active during the day. Not as much as the previous day, I guess, because the volume's come down, but still active supply, but demand is okay. So that's not a day for me that I would need to do anything at all. I would still be a maintained risk. This is another interesting candle. Again, the market is not completely decided it wants to go up, but it's not completely decided it wants to go down. I'll go ditto here, but we can see we're losing ground. Are either of those candles a reason for me to manage risk? No, they're not. That one's certainly not. That one's a candle that I would happily add risk to on that candle because it's doing everything I want it to do. That indecision, that supply that was creeping into the market but still being bought into, appears to be out of the market on that day. And then we get to here, which is the 21st, so that's yesterday now. And we're hitting $1. It's a big round number. It's a place where some people who got in at 50 cents are doubling their money. It's a natural place for supply, and we're seeing that come in. This is far more of a concerning day for me. It's big, it's black, less of a lower shadow. Is it a reason to manage my risk? It's very close. It's very, very close. And if you said to me, Carl, look, I saw that candle, I didn't like it, and I took some off the table. We're not even going to talk about how much because that's way beyond the scope of today's presentation. But I managed some risk on that table. Let's talk in terms of plus R equals R minus R. I would say to you, okay, I get it. Yep, big round number at $1, big black candle, not much of a downward pointing shadow. I get where you're coming from. Me personally, I would wait for one confirming day and then go, and there it is. So for me, on a day like that, it becomes more obvious or more pressing to manage the risk. And we're there today. So that's today, but here's the caveat, and this is so important. Today's not finished. We're still trading. So let me remove that because we don't know when today's going to end. Okay, we could see a nice long shadow develop. It could turn into a white candle. It could come all the way up here. And then we would have regretted that we traded based upon a signal that's not closed. It's not complete. We haven't had the full demand side picture for today. Not everybody's voted yet. And we must wait until the polls have closed until we can make that decision. So today I'm going to refrain from actually putting a note on there, but I can say if it closed like this or worse, then I can see reason to manage some risk here for me. And that's as simple as it gets. But Carl, Hastings Technology is they're doing these great things. It's not relevant to me. It might be relevant to you, and I encourage you obviously to do whatever you feel the most comfortable with, but you're here, for about an hour on Wednesday to learn how I do it, if there's any value in that for you. All right, going to go to Clem. We've got just a couple more here from offlines, and then we'll head to your onlines. 40X Medical, which was a little bit of yesterday's hero, isn't it? But certainly one I featured heavily in my ChartWatch markets scans, and certainly I'm pretty sure it went in on that day. I'm pretty sure it went on that day. I'm pretty sure it went in on that day. But it probably also went on that day. Okay, it went in on that day. And I just know the candles where I'm more than likely going to put it in. That one should be, not that candle there. But similarly, we can probably do a little bit of a case study for where we would want to reduce risk here. And I won't do this one because it's very much the same as this. So let's go back here and pop up the peaks and troughs. Okay, and the way I'm doing that is very simple. A higher high and a higher low, okay, creates what I call a short-term uptrend. Okay, so I'm able to start drawing this line up, and as soon as I see a lower high and a lower low, which is actually on this candle here, so in this candle here I can't draw the line down, but on this candle I can. Very, very simple. I can start drawing the down line, and now I'm in lower highs and lower lows, and then I get a higher high and a higher low, I draw an up line, and then I draw the down line. It really is that simple. But what it does is it helps me quickly see where my points of supply are, POS, and my relevant points of demand. And for me, I don't think that if something is in a strong and sustainable short-term uptrend, don't about the long-term trend, that's over here. But if something's in a strong and sustainable short-term uptrend, it really shouldn't be printing lower peaks and lower troughs. Okay, and for me, because I'm more of a momentum trader, and you do it the way you want to do, when I see that occur, I have no choice. Okay, this is not about what I think about 4DX and their technology or the contracts that they're signing. Those things are so irrelevant to me. All I care about is demand and supply and price. And if something is in a healthy uptrend, I'm happy to add risk. If it's not in a healthy uptrend, then I must do this minus R. Okay, so I think that's the first obvious point that I would manage my risk there. Obviously, closing beneath a short-term trend ribbon is a big no-no. It actually didn't do that. It's being dynamically supported still by that short-term trend ribbon. So we can therefore create a next point. We've actually also got a little trough there. I can't draw the next peak. I don't know where that's going to be, but I can certainly draw that trough in because we've started heading up the other side. So what that means for me now is I've got another point of demand here. And what I've got there is another point where if I close beneath it, I'm not there yet, but if I close beneath it, I know I've got another place to manage my risk. And these things kind of stack and add on to each other. So if I was to close beneath the point of demand and also close beneath my short-term uptrend ribbon, for me, that would be manage risk. Okay. And you might say, hey, Carl, what's going on here? Because if you got in, how can you get out twice? Okay, well, I never get in. All at once, and I never get out all at once. It's just my model. So if we look at where I would have added risk on this, and if you kind of think in these terms, I want you to really think about this for a second, because it'll make my model just go, oh, okay, I get how this guy operates now. Before I didn't quite get it, because he told me he would happily add risk on this day here. right? And I'll just go through, and this big black candle, it's engulfing. I like to think that we're all on the same page here, that that day there, I wish it would just be where I want it to be. That day there is a bit of a, not a bit of a, it's a minus risk day. And you go, well, Carl, you got in on that day and you got out on that day. You know, I'm just using round numbers here. You bought 100 shares on that day and you sold 100 shares on that day and you lost money. Yep, probably. But I'm still pretty good on these ones. Okay, and that's just how I think. I don't stress myself with what's being said in the papers or on that favourite website or by that social media guru. I just go plus R equals R minus R. What are the candles saying? That one's probably not an, oh gosh, that's not great. By here, I reckon that's not good for me. That one there, oh gosh, go to where I want you to go, please. There we go. Let's get rid of that one. Yeah, but I probably should have kept that out. Maybe adding some risk there, adding risk there. And all I care about is, and even not so much, but overall, once I'm finished, eventually once all the risk has come out, how did I go on the trade? Because I think for most investors, they're so transfixed with where they put all the money they're going to allocate on this particular trade in, and where they're going to take all that money out at the end, that they just get so frightened to act. Or should I buy? It becomes really important, doesn't it? Where I buy and where I sell. And when it's that important, we've got so much emotional capital invested in that decision. Well, we don't make good decisions when we're emotional. I wrote I think it's a really great article about that today on the site. You should go check it out. The monkey and the banana. So I think this is just what I found, and I didn't start with this approach. It took me decades to develop this properly. If we move to a system where no single add risk, minus risk, maintain risk matters that much, then we just follow the system. We just go, oh, big black candle, big white candle. What do I have to do? And we're better able to move on. And then we just look at the net, because people get focused, oh, I got in at 60 cents. I can't get out until it goes to $1.20. Or I got in at 60 cents and now it's 40 cents. Well, I can't get out until it goes back to 60 cents. Whereas my mind is going, well, what are the candles telling me to do? Philosophically speaking, let's move on. I'm going to go to Philip, who's got ESK, and then I'll do one more, and then we're on to the online requests, and we'll start moving a bit quicker because I think we've got some of this sort of foundational stuff out of the way for today. We've always got new people coming in, so I like to cater to them. It's important that we go to our default zoom before we do our next bit of analysis, so we can get a better idea of how each chart we're looking at corresponds to the other, particularly if we're going through a scan list on a date. For example, my ChartWatch scan list, comparing each of them. I can see straight away volume is a little bit sketchy, is probably a good word. 500,000 shares. There are some days like that day there. You can see up here the volume was 69 shares, and that's a bit of a red flag for me. So if you're trading 69 shares on a 45-cent stock, you know, that's less than well, it's much less than a price of coffee, certainly over here in Perth. But that's a little bit of a concern, okay? Doesn't mean you can't trade these, but just understand with that little, those few number of shares trading, there's very little that could get in the way of a big order or a big market order moving the price completely in the opposite direction of what you wanted, or creating a candle that really has no meaning because a big black candle occurred because of 69 shares, or a big black candle occurred because of 69 shares. So that's a bit of a warning sign for me. We can see that it causes the candles to be a little bit sketchy as well. So you get like these full ones, these ones that don't make any sense, and then you get just these ones where the open, the high, and the close, and the low were all the same price in the day because there were so few traded. So I do wonder whether I should even bother doing analysis on this. But we still have trends. We still have price action, and to a lesser extent we have candles. So let me just comment mainly on the trends here and leave the other stuff and say that there is a short-term uptrend. There is a long-term uptrend. It does appear that shorter-term traders are embracing this, and in the longer term, positional investors are also looking to get involved. I can see strong price action in that the moves up are much bigger then sharper than the pullbacks, that's always a good sign, because when something goes up quickly, the natural response from somebody maybe who's been in it for a long time looking to get out would be to sell, and for other people who haven't bought it to go, oh, that's gone up too much, I can't buy that now, I've missed it. So it might increase supply and it might increase demand. If you've got that combination of increased supply, oh, that's gone up a lot, I've been waiting for that, maybe I should sell it, or that's gone up a lot, or I can't buy that now. It's natural to see a stock pull back. That's why we get pullbacks. But if it doesn't pull back, then something really interesting for me has happened. Think about what I just said there. It's natural to get pullbacks after a sharp run up. But if it doesn't pull back, then something really interesting has happened for me. The people who own it always bring it back. And again, this is why I don't do fancy indicators and silly candlestick names, because I just bring everything back to demand, supply, price. If something goes up a lot, like something like this one has, and doesn't pull back, well, the people who own it aren't going, that's gone up too much, I should take advantage of this. They're going, yep, finally the market's recognising how good this is. They're not selling, they're hanging on. That's important. The people with cash potentially looking to get in aren't so fazed by that move. They're going, okay, this is still good value here. I'm still going to be on the demand side. And that's what I'm seeing here. So look, there's some good stuff happening. Could I add risk to this? Look, I'm probably on the camp of abstaining, just on the basis that it's crazy illiquid. But I've seen far worse charts than this. I can see short-term demand side control and I can see long-term demand side control. So let's just leave it there. Then I'm going to go to the final offline and then get to your onlines, and it's for Hub and Marcus. Look, it's a question that I've had many times from you on the emails this is the 4th week now I think we've been going, about this idea of periodicity, which is just, am I looking at daily charts, weekly charts, monthly charts, or otherwise? For me, I'd never touch anything lower than a daily. I don't look at hourly charts, 5-minute charts. I just think they're for people who want to stroke their egos and feel like they're day traders, But it's the worst thing, in my opinion, that you could do, just from my experience, is look at the markets constantly, because you'll be jumping at shadows all the time, or jumping into things and then jumping out after 5 minutes, and you just make the most horrible mistakes. I prefer to look at the market when it's closed. When it's closed, it's very hard to make a mistake because the market's closed. By definition, if I want to do something really emotional and stupid, I have to wait till the next day. I have to sleep on it, wake up that next day and go, you know what, I still want to do that stupid thing. And by then, I'm probably more likely just to follow my system. So for me, it's important to do my analysis when the market's closed, and only when the market's closed. We've said that 1,000 times. It might be important. But some people can't. For me, I say, which periodicity should I use? Well, it's the one that meets my trading style, and so they both have to be true. It's one of those in Excel, true and true equals true. And I can check the market in line with that periodicity. So it suits my trading style. So I'm, as you've noticed, a little bit more short-term in nature. Therefore, I'm on daily charts, and I can check the market once a day. I literally do that for you each day in ChartWatch. That's me doing my analysis. The analysis I would do whether I was writing for Market Index or not, that's me doing my analysis each day and sharing it with you in ChartWatch ASX scans. That's my exact analysis. So I can do that every day. But I might be a person who doesn't have time to do it every day. I might only have time on the weekend. I can spare a couple of hours on the weekend, and that's all I can do. Well, that puts me to a weekly chart, regardless of what my trading style is. Oh, Carl, I want to be a short-term trader, I want to be a day trader, but I can only check the market on the weekends. Okay, well, that's just silly. Carl, I want to be a short-term trader like you, but I can only check the market on the weekends. Well, you can't, because you need to be able to check the market in line with the periodicity and when it's closed, and that puts you on a weekly chart. So I think that should really answer the question. There should be no confusion. The next part of Marcus's question is, well, why can't I be on the daily chart periodicity and then check the weekly chart to make sure? Or why can't I be on the weekly chart periodicity, which was his exact question, and check the daily chart to be sure? And I say, hey, Marcus, you can do whatever you want, but I prefer not to. Once I've chosen my periodicity, I stick to it. And that's just about being consistent. I don't chop and change. I don't look for others for confirmation. I know other traders do this, but that's not me. And this is the reason. I find that when I start chopping and changing, I talk myself out of things. If I see a signal on the weekly chart looks great, and then I go to the daily chart, I see one black candle, I talk myself out of it, then that would be a shame if it kept going up because I had a signal on the weekly chart. If I'm not consistent in what I do, I won't get consistent outcomes to analyse. Okay, there's this old saying called garbage in, garbage out. That means if you've got a random process in, it's an old computer programming term. If you give the computer garbage or randomness, it's going to spit out garbage. And that's the same with our trading. If we're random in our approach, we'll get random results. Some will be good, some will be bad, but we'll never be able to go back and say, that's the thing I did consistently. I can see that. I followed the trend, I made good money. But it'll also show you, okay, on those 3 trades, I didn't follow the trend and they came out with losses. Well, I need to follow the trend, I can fix it. If I'm random on the way in, I'll never know what made me the money or lost me the money. I'll never be able to fix it. So for me, no, Marcus, I think I've answered your question comprehensively, and for everybody else about which periodicity I like to use and why, and whether I chop and change across them. Okay, let's get to your online request. Thank you for everybody who's been waiting there so patiently. And if I won't end the webinar, that's good. I nearly did. Clicking the wrong button. And now I get to your request. Okay, I'm going to start from the top, work my way down, and then I'll randomly go to the bottom and work my way up. I won't tell you when. QAU. This is the BetaShares Gold Bullion currency hedged. And this one is for Dave. Now, Dave, there's no point looking at this one, is it? Because this is going to move lockstep with what the gold price is doing. And you're always welcome to type in your favourite ETF. I'm going to look at it, but be prepared for such a response. There's no point doing technical analysis here. We need to do technical analysis on the gold chart. The good news is I did technical analysis on the gold chart earlier on and on the silver chart, and we pointed out that there are some candles there that are consistent with a substantial amount of supply coming in, and also an increase in indecision amongst market participants. And neither of those things are consistent with a low volatility uptrend. And therefore, if that's the case, if we're trend traders, looking to manage our opportunity costs, again, go read that article I wrote today, The Monkey and the Banana. This is the real reason why we go minus R, is to say, well, this run is potentially going to become a bit more difficult. So minus R, get some money out on that and go use it on something that deserves a plus R. Now, we don't have to take all of our money out. I mean, that's the way I operate. You do it the way you want to do it. I don't have to be all out. I can still maintain some risk exposure to this gold theme. But the candles and the price action, the volume, the volatility are all telling me that the environment, the demand-supply environment, and everything comes back to that for me, is less conducive to warranting a full risk position, FRP. So I'm just going to reiterate that now. That's still my view, okay? And you can interpret that any way you like. Let's go to NWL. And this one here is for, it's not that one, it's that one. This one here is for Peter. And if you're just wondering why there's some weird things that happen, it's because I have in my data feed all of the current stocks and any stock that ever was on the ASX for about the last 30 years. So you can see this is Newtel back in the .com days. So this is a stock I would have traded my little pants off back in the day, as in my early 20s. Over here, making where I should have been at university, at lectures in the Octagon Theatre over here at UWA, but I wasn't. I was in the city, in my broker's office, trading my little brains out. And I can tell you, yes, probably making a lot more money than any of the lecturers were making at the time. But we digress. That's why you might see something weird. So I generally just go, that's not it, and then I tap to the next one. But this is not about Carl's investing life story. This is about what you want to hear about. Let's go to Newtel, and it looks like we did some work on this last week. Because I did some arrows all the week before, so I'm going to just delete those and get them out of the way, and we'll just start again. And we'll say that everything up to this point here is either equals R or plus R, no problems. And my model, I don't know if you've noticed, it is a bit unfortunate, cannot tell the future. All it can tell you is what the demand supply environment is doing up to a particular point. And I can say that on that day there, I had no indication. Is volatility rampaging and out of control? No. The volume looks all looks pretty benign here. Short-term uptrend, long-term trend, incredible candles, strong motive phases in the price action. That's the movement phases, and very shallow stagnation phases. It all looks hunky-dory. But we don't know what candle's going to come next. Is that a candle that I need to worry about? Hopefully we all agree no. It's still equals risk. Happy to add risk if I get a really nice candle next. Is that a really nice candle to add risk on? No, that doesn't warrant adding any risk on that day. This is how ChartWatch ASX scans work. If I think it warrants adding risk, if it's a plus R, it's in the scan. If I think it's a really strong one, it's a feature chart. That's literally how ChartWatch scans works. So you wouldn't have seen it in that day or that day. Not that it doesn't have a wonderful trend, it's a wonderful trend, but just those candles don't warrant adding risk on a day. Now, we can see an upper shadow coming in, or Carl, you told me upper shadows are bad. That's the day we've got to dump the lot. That's it. Let's get out. It can't be good. No. It's not the way we're going to think. It's a tiny little upper shadow. It's minuscule within the context of this broader trend. Oh, another one there. But we can see there's a little bit of supply, a little bit of indecision, nothing in the volatility, nothing in the volume. If you're wondering where I'm looking here. See how all of these pieces of the puzzle come together? Now we've got some volatility. Now we've got some indecision in the market. Now we've got a little bit of volume as well, above average volume. Okay, alarm bells alert. We've got less consensus in the market. We're now more prone to volatility. We're now more prone to volume. We're now more prone to price action that is not consistent with what we've seen. But how did we end up? Look at the price action. Long lower shadow. Yes, there was probably some news that day. I don't know. Because I don't care either, ladies and gentlemen. Because if there is news and something bad happens or something good happens, it's here in my candles, isn't it, to be fair? But all is okay at the end of the day. It wasn't the perfect candle. We saw a little bit of a slippage, but still a lot of demand coming back in. How do we know there was, well, at least above average demand coming in? How do you know? Look at the volume. We had above average volume. So above average supply on that day, above average demand came in, excess demand, and the price action tells us that the demand side mostly won the day. That's not good. Is that a reason to minus R? Some people are nodding their heads feverishly. Yes, Carl, that's it. I'm out of here. And it will be a little bit of a style issue, but let me help you understand my thought process. No, not for me. Everything else, it's a balance of probabilities. I still think everything else is still very, very strong, but I'm definitely on alert. And this is where I start to peg areas. And I say, look, I just cannot tolerate the price moving beneath that shadow. That shadow was where an above average amount of demand came in, excess demand came in last time. Now, if we were to close beneath that shadow, it tells me not only that we've got some substantial supply in the system, but the demand has been consumed. Like it thought that was a good price last time, but they're not thinking it's a good price this time. Well, what does that mean? I don't like the sound of that. And if I don't like the sound of something, I don't muck around too much. Because there's always that opportunity cost nagging away at me. So this is, I think, and we've closed beneath the short-term trend ribbon. So for me, this is an obvious day to just manage some risk on this trade. And probably because of the nature of the candle and the few candles before it and closing beneath the short-term trend ribbon, it might get, a bit more than other ones. And we'll get a feeling for what that day there is not good either. So what's been happening at the short-term uptrend ribbon, for the most part, not always, but for the most part, the uptrend ribbon has been an area where the price has been cradled, it's been supported, and the price is rebounding. And we're seeing with this upward pointing shadow, which is not getting past the balance point of the previous candle, that midpoint. You hear me talk about that balance point often. Supply side is gaining control here. And in the short term, I'd almost say supply side's got control here. The long-term investors, they're still getting prepared to buy the big dip. But the shorter term traders, they are unable or unwilling to continue to buy the short term dips. So for me, and again, you can do anything you guys want to do, and girls, that's how I feel about that one. And I don't know if you've noticed, my system is a little bit subjective, isn't it? Now it's based upon objective things, which is what's the candle color, is it, what's the shadow, is it long, what's the price action, it's based upon a lot of objective stuff, but ultimately it is a bit subjective. Now the big question becomes, because I think we're getting close today but not there, would we add risk on these days? Would we add back risk? And for me the answer is no, because, well, I'm below the short-term trend ribbon. That's not good. The amount of demand that's come in hasn't even eclipsed yet the balance point of this move down. So we can take that balance point theory, and some people will say, oh, Carl, that's just a Fibonacci retracement. Well, I don't think Fibonacci owns, he hasn't trademarked the idea of something, at least moving halfway back up a range. And I'm just going for consensus. Well, in this country, if 51% of the population vote for a particular party, then that party tends to be in control. So this is why I use this idea of this balance point. And if we can get halfway back up this move here, then the demand side is more than likely back in control. And we're not doing that. So none of these candles are ad risk for me yet. Not that one. We can see, actually, that's the latest one. We've got 22. We can see the supply coming back in. And the problem here is we've got this point of supply up here. And the question mark now is, well, is supply building? That happened to go shift. Is supply building? Or is the demand able to push through it? And for me, there's a big question mark here. So you can see places where I would have reduced risk. I mean, even potentially on this day here, if I still had some left. But I haven't mentioned it today, but I often operate in thirds. This is just my model. You guys, and I wanted to take that out because you need to operate in your own methodology. But if I still had risk at this stage, I'm really watching now for a big signal, like a long upper shadow that pushes back into this point of supply. And that shadow tells us that demand was coming in thinking this big trend is still in play because that's what they've been programmed to do for so long. And yet the supply saying, no, we've gone from buying the dip to selling rallies now. And that's the signal I'm waiting for here. And if I saw that, and particularly if I'm closing back below that short-term trend ribbon again, it's just too much for me to bear. Too much for a shorter-term trader who likes momentum, wants to allocate risk in the right places. It's just out for me. Now you're like, hey Carl, Netwealth's a great company, it's got great fundamentals, and no problems. I'm okay with that if that's the way you think. I'm on a weekly chart. I don't know if anybody noticed. Well, I meant to do that, ladies and gentlemen. This was a deliberate act, of course. This is Carl, 100% ahead of the curve, and explaining to you how a weekly trader would assess Netwealth Group. That's what I was doing there. What a fortunate accident, okay? Did I do anything different? I did nothing different at all. And yet we have automatically just gone 5 times longer term than if I was on a daily chart. And maybe some of you in the Q&A are screaming, hey, Carl, you stole the weekly chart. I didn't mean to do it. It's a happy accident. Nothing changes for you weekly traders out there. Potentially somebody managing, like a super fund or something. Why can't you do the analysis I did and manage your risk, add risk in the same way? Now, for shorter term traders, you wouldn't have any idea any of that analysis occurred because, wow, you're here. You got your signal here. Like that day there, I don't like that day there at all. That's a managed risk for me, even that. And wow, can we see, even this is, oh gosh, I love this. I'm so happy now. Even though we saw that long-term uptrend ribbon do exactly what it's supposed to do, demand came in, the longer-term positional buys there came back in. Look at what I was talking about on the weekly chart. So for you weekly traders on Netwealth, I said we're watching now for that increase in supply, that build-up in supply, to tell me that we've flipped from buy the rally, demand-side control, to sell the rally, supply-side control. We got it here, didn't we? That's exactly what we got here. And that was really your final straw that broke the camel's back on risk on this one. And the question is, would we be adding risk here? And it's much the same as in that last example. We're not back up the balance point. Yes, there's some decent candles. We're still flirting with the trend ribbons. This is not clear-cut demand-side control for me just yet. I still think there's plenty of questions to answer for Netwealth. Wow, what a great case study that was. How am I going for time? Awful, as usual. So I will commit to doing another 5 more. I'm going to take Way. You've been very patient there, I know, and help me out with the sound and vision this morning. So let's do your Wisetech, which is a great case study to go to next, because, and hopefully people aren't furious with me at not getting to their requests, because I think this is largely also about learning the model as well. And then if I teach you how to give a man a fish, like if I do all your requests today, it's just giving you a fish. But if I do it in this case study fashion by teaching you how to fish, you could just go and do your own analysis after this webinar's over, and tomorrow and the next day and the next day. And I think that's brilliant. okay, I think Wisetech's got some problems, pretty obvious for me, and I don't want to demean anybody by saying you should have seen this as well, but for me it's obvious, and that's, I think, one of the beauties of my system is that we've got problems here. We've got a short-term downtrend, we've got a long-term downtrend. That can't be good. That can't be telling us that the big fund managers, don't worry about us, the big fund managers who matter, who have the big money and the influence, are they falling over themselves to buy this stock? And I can guarantee they do fundamental analysis. I don't care, but I guarantee they do. And what analysis have they come up with? What conclusions are they drawing right now? Well, they're not falling over themselves to buy. So already for me, we know that equals R and plus R, these two options for me are off the table. Oh, but Carl, Wisetech, it's such a good company. They're global groundbreaking software. They do logistics software. They're the dominant force. I'm sorry, I don't care. All I care about is demand, supply, and price, and what ultimately other people are thinking about. And that's what we're seeing here. So price action is demand side control. It's very clear. I mean, this is unequivocal here. Lots of black candles. What we're seeing here is it tries to rally, gets beaten down. Whether that be with my trend ribbons, the price action, or intraday, candle by candle, tries to rally, gets beaten down. And here's the thing. I was going to say, and what's the rest of the market doing? The rest of the market's going up. So if this was just performing in line with the market, nobody had an opinion on it, it was just doing what the rest of the basket of stocks are doing, the ASX 200, it should be going up. The fact it's not when everything's going up tells me that investors do have a strong opinion on it. So it's not just, oh, well, the market's going up, let's buy some Wisetech, because that's what passive funds do. Active fund managers that do research and take positions, long or short, right, they're not buying this in line with the market. And this comes out in this RSC down here, this relative strength comparative indicator. And there are different versions on the internet and on TradingView you can find. This is my custom one. This is the best one that exists. I know that for a fact. And it tells me when a stock is performing in line with the market, that would be a 0, or beating the market, or failing against the market. And we can see here the red bars are not a good sign. So for me, and this is why Wisetech has appeared several times in my downtrend scan list, even as a feature chart. I reckon it appeared as a feature chart on that day there as a minus R. I'm pretty sure it featured this day as a minus R on that day. And on these 2 days as well, minus R, minus R. And today, I'm ambivalent. I don't care. It's not giving me a signal to reduce risk. Sure as hell ain't giving me a signal to increase risk either. Okay, we're going to go 4 more with my promise there. Going to go to Domino's because I know I can do this very quickly. Let's go Ditto. Now, Tim, Domino's is one of my most featured downtrends in ChartWatch. I won't put the minus R's on this chart because, as you would probably agree and imagine, it would be full of minus R's. But has it turned the corner? Yes, Carl, very good. Your model, your system has done very well up to this point. Okay, well, look, this candle's interesting for me. It's just blipping there on the can we see it there? Nope, it's not doing lines down here, but you can see down here. We've got a little blip on volatility. We've got above average volume. This candle is interesting for me. Could that be the candle that stops the rot for Domino's and begins the next bull market phase that takes it all the way back to, oh my gosh, $170? Ladies and gentlemen, hopefully you're starting to see why maybe just listening to a model that follows trends might be better to listening to quote unquote experts. Long way down, isn't it? Look, it could be. This could be the start. I don't know yet. That's my honest answer, because I'm not seeing enough signs here in the stuff I need to see to tell me that that's the case, that the demand side has taken control, because the supply side's been pretty damn strong here, okay? I can go so far as to say, this might shock people here, but that candle is significant to me. It matters to me. Not as much as this candle, obviously, but it's got my attention. This will shock people that I'm going to do this on Domino's, because if you know me, you know how forcefully and readily I've been able to go minus R on this stock in particular. I'm going to go equals risk for the first time, I think, in a bloody long time. As in, I think there's enough evidence to suggest that if I was in it, now there's no bloody way I could possibly be in it, of course. But if I was in it, I can see reason just to hang on for now, okay? Now that would change with a big black candle. I'd be back to minus R. But there's just enough evidence that the demand is potentially starting to come in to at least equate the supply. Now, even that equals R, controversial, is tentative, because my brain's now thinking, well, while this is going sideways for the next 6 months and doing nothing, maybe that risk is better placed elsewhere. But I'm not in it, so I don't have to make that decision. Okay, we've got 3 more to go. I'm going to scroll down to the bottom list where everybody is furious, no doubt, and they've probably walked away, or there's a big crack down the middle of their screen because Carl's not doing my my request today. Tony's saying, what does the RSC 63 mean? It's the relative strength comparative. It's a custom indicator. It's mine. I'm sorry, I don't share that one. I'm happy to share with the trend ribbons, but that's something I've developed. But you can find this. You can find something very similar on your trading view, like you can with my OTR and volume is just volume. I haven't mucked around with that. And so, yes, I think it's a valuable tool because it's another independent piece of technical analysis, because if you use the MACD, stochastics and all of that crap, you're not getting new information, ladies and gentlemen. I know it makes you feel good, or look at what a big technical analyst I am, but those indicators, number one, they're useless because I've tested them and I know that. Number two, when you put them all on the chart, it just clutters your chart and you can't see the damn candles in the price action, which is ultimately where you want to be because it's pure demand and supply. Rama's got, Carl, with reference to discussion of trend following Netwealth, you keep talking the next day price at a weekly chart. Confused. Well done, Rama. You should have been confused because I was on the wrong periodicity, but was I? Peter picking up the same thing. Kathy's got CDA. And what are we? I think we're maybe 2 more after this. Apologies if your boss wants you back at your desk after lunch. Codan, I still think looks very good. Many of you now have your eyes tuned into these black candles. Like, is that fair to say that the first thing you noticed just then was that candle and that candle? You're like, oh, okay, wait a second, that's not good, and it's not ideal, but it's not a deal breaker yet, and hopefully. This is 4 weeks now. You've been listening to me. You're starting to get an idea, some perspective on what is a deal breaker and what isn't. But what we can do objectively now is draw in our peaks and troughs and objectively identify that we are, I reckon, at this high here. So I can check off 34.18 and this high here, 34.20. So that's still a high today. So even if today closes there, it won't actually qualify as a lower point of supply. So we're just waiting for that next point of supply to form. We're still therefore, by definition, still showing rising peaks and rising troughs, or rising points of supply, rising points of demand. I think points of supply, points of demand make more sense, don't they? I mean, that's what they are. So look, I'm still okay here. There's nothing in this chart that instructs me to manage my risk just yet. However, that doesn't mean that we can't start to peg areas where we will really scrutinise this. Okay, and depending on the candles when we get there, we'll make some calls. But certainly if it closes beneath that point of demand, for me, I have to manage my risk. That's my job. Okay, if it closes beneath the short-term uptrend ribbon, I have to manage my risk. That's my job. Okay, and depending on the severity of the candles that we get in the process, that will determine additional managing of risk. But until then, all I can see is a healthy uptrend. So I'm equals R for here. Am I plus R? No. We're watching those candles. There's got to be something else out there today that is more urgent in terms of plus R, isn't there? So not that one today, but I still think that one's fine. That's my opinion, but that could crash tomorrow, couldn't it? It could crash tomorrow and I wouldn't bloody know because I can't tell the future. All I can do is base my decisions on what I can see and what is MOTN. And I won't even define MOTN for you. Let's go to Priya, who's got SRL. And I'm pretty sure we're one more after this. See, this is a problem for me because I thought this looked really good here. So this one hurts a little, and nothing goes up forever. We know that, and because we're in elevated, look at this, we are in elevated volatility. Sorry, I was going to say volume next, and we are still elevated volume. We know that things can happen quickly. That's the difference. Now this candle isn't closed, but if it closes there, it's gonna start to mean something for me. So look, I'm going to abstain and say, based upon the candle I can see, it's still equals risk. Maintain risk for me. This is starting to get to the point where I'm getting a bit concerned because, again, it's close to the short-term trend ribbon. There's a little area here which there should have been demand and there isn't. Not that that's an official trough, it's not, but it does. My eye is drawn to that area. Let me just clarify what I've said here, because that's what people want. They want me to make a call, don't they? For me, until I see the close of that candle, it still equals R. If it closes like that or worse, it's very likely going to be a minus R. But that also means there's still some risk on the table there as well, because everything else is still good. It hasn't had so many strikes yet that I believe it warrants having a ZRP, or a zero risk position. And now we're going to our final one for today, which is CSL. Which we actually said last week when we looked at it. So I'll do this very quickly. MRP, because we were using MRP last as maintain risk position, but I've changed that this week to equals R, which I think is so much better. Ditto. Look, it's very much like Domino's. And the Domino's one we said started with a particular candle that caught my interest. And for me, that's probably the first one there that does so. We can see above average volatility down here. We can see above average volume here. Obviously a big move, a gap, a run, a close near the high. And that's the first point where if I was shorting this, and you know I had this as reducing risk all the way down through here, I would stop shorting it. Probably cover back some of that short side exposure. I'd probably moving more to a neutral position here. I don't want to be long and I don't want to be short. But I know some people, they didn't sell CSL all this while ago when I started putting it in as a minus risk. Okay, minus risk, ChartWatch, go check. It was featured probably 20 times from that point. They didn't sell it, they hung on because it's such a great blue chip stock. And they hung on all through here because that's what they do. They'll never sell CSL. I'll have to pry it out of their cold, dead hands. But for you people, and you're welcome to do it any way you want. I'm not telling you how to do it. I can get to maintain risk. I said that last week, and I'm still there because I can't see any reason that if you had it, that there's a need to reduce risk at this stage. What would change that? What would have me reducing risk? I wouldn't want to see it close back below there. That would be a big no-no. Also beneath the little trough that's formed. And then, that would be a deal breaker for me. What would see me add risk? We're still so far away from that because I need to see how it interacts with the long-term trend ribbon. Oh, but Carl, by the time it gets there, it'll be up another $20. Okay, that's fine with me. I don't care. I don't know if you've noticed this. I don't care what price I get in at. I don't care what price I get out at. All I care about is following the trends. That's all that matters to me. And on that note, let's remind everybody who's watching us on the recording to like the video. Hopefully you did like it. And that's why you're clicking the little thumbs up button. And of course, subscribe. And that way you'll get notified every time I produce new content for Market Index. Apart from that, ladies and gentlemen, it has been an absolute pleasure chatting with you today. Hopefully you got lots out of it, learned something new about trading and investing. That's my goal. All the best for those endeavours. Until we catch up again, bye-bye for now.